Good afternoon and welcome to the Altitude Group PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Nikki Stella, CEO, and Graham Feltham, CFO. Good afternoon to you both.
Thank you, Alessandro. And can you hear me okay?
Yeah, perfectly.
Wonderful. Well, we're really pleased to be here today to share our results and for the year ended March 31st, 2022. And I'm here today with Graham Feltham, our CFO, and this is our presentation team for the day. I've been in the promo industry for 17 years in executive level leadership roles. And I've been on many different investor presentations with Altitude Group. So I'm going to pass over to Graham because I'd really love for him to be able to give an introduction to him and his background. He was here with us for the interims, but it will be great to refresh everybody. He's been a wonderful addition to our team, a wonderful commercial CFO, and we're thrilled to have him on board. So Graham, with that, I'll pass over to you.
Thank you very much. Thanks, Nikki. So I had the pleasure of joining Altitude at the end of September. And yeah, just in time for the interims. So I've had about 10 months with the group, and it's been exciting, challenging, and excellent time and especially to get the pleasure working with Nikki, who is what she is. She's an ambitious, driven, and great CFO, great CEO to work with. So just a little bit about my past. I'm an experienced AIM PLC CFO and board member. I've had experience within tech services within AIM, and then within private equity or trade owned. Then that's FMCG and services. I went through a transaction with Safety Clean between Warburgs and Apax Partners, and I kind of really enjoy that AIM environment as it's dynamic, as you can really get involved in the business, close to it, and it's always about rolling your sleeves up, which is really what we're all about. So yeah, that's me. Qualified with EY in 2000, but apart from that, that's me, and I'm pretty excited to be part of the team.
And we're really thrilled to have Graham with us, and roll up our sleeves we do. And you'll learn more about that as we go through the presentation today. But it has really been a transformational time and maneuvering through the COVID environment into a new era. And we're really excited to share our results and dig into the year. And so what I'm going to do is I'm going to allow Graham to talk through the financial highlights, and then we will start to really talk about the performance and all the different variety of things that we're doing within the business. So Graham, go ahead on the highlights. And also what we're going to do right now is we're going to turn off our cameras so that we can get a bigger slide for everybody on the webinar today.
Excellent. Thanks, Nikki. So year in a nutshell, it's a COVID year. It's been a COVID year, but a year of recovery. We've increased our revenues. We've replaced the 2 million of PPE sales that we had last year with core recurring repeatable revenue. The growth in the profitable growth that we had within the years, driven mainly from the underlying core services business, where we achieved 17.3% uptick on our year-on-year services division line of business. We've also proven out and had a successful evolution of ACS, which is the main driver behind our merchanting side. So it's really FY22 is culminated in delivering it as a platform for growth. It's been it started in September 19, and it's really now something we can springboard from. So
and if I could just add really briefly too, Graham, is on that COVID PPE, that really showcases the entrepreneurial spirit and the roll up our sleeves that we were just talking about. So, we acted very quickly in order to be able to shift gears, continue to drive growth, which we'll talk about in a few moments of how we've done that through the years. But we were really nose down on making sure that the business continued on its growth trajectory, even through the most challenging of times. And with that, I'll hand back over to you, Graham. But I think that's an important matter to note there, that we've been continuing to grow over the years, regardless of the environment that we've been in.
Absolutely. Thanks, Nikki. And then just moving on to gross margin, then we've reflected 51.5% gross margin in this year, which reflects the blend of group revenues that we have. It's an expected reduction from 72.3 as we have the uplift of ACS revenues in our mix, which has then driven that down. That's an expected and planned position, so it's not a surprise. The overheads have been consistent year on year, so we've managed the costs on those, and we have achieved a 1.1 million increase, adjusted operating profit, an increase of 90%, which then flows through and reflected in our adjusted EPS trend as well. So we're definitely, it just really shows year-on-year growth that we can show, for the last few years.
And I think to Graham's point is that springboard, right? And so, if you're ready to flip to the next slide.
Sorry, I think we both did that.
Yeah. So I think that that next slide is really one that's an important one. And so go ahead, Graham, with the cash flows and cash balance.
Yeah. So we have a 1.1 million operating cash flow before changes in working capital, and we'll come into the cash flow a bit later to go into that a little bit more detail. But that's a flow through from trading, and we do have and then our cash balance as at the year end of 0.9 million. Soon after that, so we've quoted 30th of June position here at 1.6 million. That's because we receive an awful lot of cash straddling the year end. That's our normal cash cycle. So that really pivots around the year end. So it could be up or down. But the 1.6 is then reflective following in the following months after that. And it just really reflects the services revenue, as we've mentioned. The industry average was 12.1%. For the calendar year 21, and we've shown that growing by 17.3%. So there's an element of recovery, but there's also our growth and our model showing through there. And we tend to have we've had strong trading momentum in our last quarter of the financial year, and that's flowed through into our first quarter. So we've seen those continued trading momentums, our trading momentum continuing into the new year.
So what I can say is one of the really important factors to see here on that first bullet point, the services revenue grew by 17.3%. So within our network, and just recently in February of 2022, there was an industry report that stated that the average growth across the industry was 12.1%. So we were really thrilled to see that our services revenue grew ahead of pace. Ahead of pace across the industry. So that was a really, really good sign for us as we entered into our new financial year. And we've seen that strong trading momentum. So the first calendar year of the year, so January, we saw a very robust period that flowed right into the second quarter of the year, our first financial quarter of the year. And so that provides us with further confidence that the current market expectations are at least in line for the full year. And we're looking to this new year with confidence. And we can flip to the next slide. So just to give some quick background on the industry we serve, I know we have a lot of folks that are probably very familiar with our marketplace. But we'll run through the supply chain really briefly just to get everybody else, those who may not know about the industry, the supply chain and how it works. We can run through that quickly for everyone here today as well. So post-pandemic, the market for promotional products in the US alone is estimated to be worth more than 23 billion. And so pre-COVID, there was an estimated number somewhere in the 25 to 26 billion. So in the height of COVID, we saw a reduction down to about 20 billion in 2020. But that strong rebound has occurred. It's moved the market back up to that 23 billion number, and we're anticipating to see continued growth. In years past, during recessionary periods or after 9/11, we saw big bounces post those situations, and so I think that the promotional products industry is resilient. It is built on entrepreneurship, and we typically see the bounce that's happening right now. So that return to 23 billion and that increase that we expect to see as the year goes on. So it continues to be a large and inefficient market. And we'll talk a bit about this and a bit about the technology stack and everything as we go through the presentation. But approximately 75% of transactions are still carried offline. And so driving efficiency for our preferred partners, driving efficiency for the distributors that are within our network. These are high priorities for us and things that we continue to work through. And we'll talk a little bit more about how we've made some advances on our technology and really grown into an open environment with rich with integrations that help to drive efficiency and will help to drive faster ordering online through systems. So, and additionally, it's very fragmented, which we know provides us with great opportunity to grow. Approximately 3,000 suppliers across the market. Of those 3,000 suppliers, I would say somewhere between 200 of them are really your primary and largest suppliers. And there's about 23,000 distributors serving a very broad customer base. So this could be small individual customers straight through to very large corporates and nonprofit organizations. So it really just spans a very large marketplace across the US, and that's what drives that $23 billion industry. So this is a little bit about the supply chain and where we fit within the supply chain and how do we serve our network and our preferred partner programs. And so if you look, we'll start from the top this time. So if you look to that yellow column, that shows you your customer, your end buyer. So you may walk into a cafe or you may be in your job and they hand out either t-shirts or baseball caps, pens, mugs, travel mugs, all sorts of different products that have that logo, that branded piece on the product itself. And so walking into, and in this image, there's a cafe, so we can stick with that cafe premise. If you walk into the cafe and you purchase a t-shirt, that cafe owner has called upon their distributor salesperson, and that distributor salesperson in column red quickly goes into action and will process orders. So for 500 t-shirts for that cafe, once you've gone through that ordering process, it's sort of something that happens behind the curtain. So that distributor will process an order, and that will go straight through to a supplier. That supplier we just spoke about, there are thousands of them across the US and UK, and they will have a warehouse that's packed full of product. And that product could range from pens, drinkware pieces, notebooks, pads, padfolios, baseball caps, really anything that you can place that logo on. And so they will pick and pull that from their shelves and they will decorate that. They have big machinery across their facilities where they're able to decorate that product basically through a printing process, but a printing process that goes onto a 3D product versus on print. And then if you go back down to the gray column, that's where you see your overseas manufacturer. And that manufacturer could be either in China or in Bangladesh or across the globe, really, where products are being manufactured and shipped into the US and UK markets. And so who are we and where do we sit within that supply chain? And that's something we can talk about right now. So we are a technology company. we have developed industry-specific marketplace tools that provide design tools, applications, website, pop-up stores for promotional product distributors and suppliers. Essentially, what we do is we sit between those columns so that we can drive efficiency for our distributors and for our preferred partners. And so previous to the acquisition of AIM, we were solely a technology company. Upon acquisition of AIM, we now have the network of 2,300 distributors, or 2,300 distributors across the globe, 2,100 in the US alone. And so our tech suite adoption has increased to 476 users, a 32% increase across our market in the year, and we are hosting now 2,646 unique web stores. And our technology, we'll talk about that in just a moment, but it really drives that efficiency, enabling a distributor in our network to process an order with pace and also fully online to reduce actual keystrokes and to drive efficiency. So we're moving towards a click environment that drops orders straight through. We've also developed a robust e-commerce enabled and scalable trading platform that facilitates the execution of both offline and online promotional product transactions, and it gives us the ability to generate revenue based on the transactional throughput both inside and outside the platform.
Cool.
Oops, if you could back up one, Graham. Thank you so much. So what have we been up to? We've really driven efficiency through our system that drives that operational gearing. And it's really important to note that over the course of this time period, we've not stopped advancing our systems. So we've continued to advance systems to make sure they are highly attractive across the marketplace so that we can attract the 300,000 distributor in our network, in the AIM network, straight through to a $5 million distributor entering into the network via maybe our ACS program, which we'll talk about in just a moment, or as an AIM member. And so we've moved from what in the past was a more closed proprietary system to a more modern and open environment where we have integrations across our system. And these integrations really drive efficiency for our usership. And not only do they drive efficiency for our distributor members, our AIM members and ACS affiliates, but it also drives efficiency for our preferred partners as well. So over the course of the last few years, we've integrated with data providers like ASI and Distributor Central. We've helped our affiliates and members to manage their accounting through QuickBooks and tax jar integrations. So sales tax in the US is very, very complicated, and our integration with tax jar helps to manage the sales tax calculations for our network. Payment processors like Card Connect, PayPal, and Authorize.net. And then we sit on a very, very stable platform, Amazon Web Services. We have integrations with shipping partners, supply partners, so that those orders can be processed straight into the systems of our preferred partners as well. All of this to drive efficiency and to make for a better, efficiently driven system where a purchase order can pass straight through very quickly to a supplier. So when you combine the group's technology with the experienced team that we have built over the course of the last couple of years and the proven service offerings, we're able to deliver in-industry scalable growth. And also we have the opportunity to expand into adjacent markets. So all of this operational gearing and all of this effort that we've been doing provides us with the springboard that we're now able to really see those growth opportunities. And so who are we and how do we enact within the marketplace? So we deliver products and services in two distinct areas. Our revenues are through two distinct areas and buckets of the business. So first off, we have our services. This is comprised of our technology and software applications, membership subscriptions, preferred partner programs, and our marketing services programs. So all of these drop into the services line, which we'll dig into a bit deeper in just a moment. And then to the right of that, we have our merchanting programs, which includes ACS and our adjacent market programs. And these are the programs where we, the group, now act as principal in the sale of promotional products. So our services and merchanting programs, how does Altitude make money? So first and foremost, our business services, the first line here is our network, our AIM membership. And so what do? We provide them with distinct and very beneficial business services. We provide them with preferred partner pricing benefits. We're getting them the best buying power in the market. In the US, as I mentioned previously, we have 2,100 members in the AIM network. And those in that, they receive preferred partner pricing. They receive really strong freight programs and shipping discounts and other discounts across numerous different vendors. We provide them with community and networking opportunities, educational and professional development, and we also deliver to them expanded marketing services, products, and tools. And how do we make money here from the business services element? The group derives subscription fees, revenue from providing a broad range of services to our distributor members, and this includes supplier relations services, negotiated group discounts, access to events and exhibitions, catalog programs, artwork services, marketing programs, social media programs. The list really goes on and on. We provide very, very distinct tools and services, and what the goal for us to do and achieve for them is to make that smaller business, the average annual turnover for them is somewhere from $300,000 to $500,000 a year, maybe upwards to $1 million. That is really the broad base. And our goal here is to make those smaller businesses look like that Fortune 500 business. So we give them all of the tools and services they could ever need to really help them grow and look like a much bigger business, that's working behind them to provide those tools and services.
Excellent. And they also, just to chip in, they get they have the technology, which kind of goes without saying, but they have the use of the technology, and they can have more extensive use of that technology with the likes of pop-up stores, etc., to give them that bigger presence.
Absolutely, and we're seeing a big move towards pop-up stores across our systems, and that really harkens back to the 2,646 pop-up sites that we have live today. And those shift and change because it's really, really simple through our platform to initiate a pop-up store, have that go live. It showcases our preferred vendor partner products so that they can access those on, in a very, very quick turn. And then boom, they've got a pop-up store, and then they're able to take that down very quickly when they're finished with that program, or it might stay live for them over the course of a year or longer. So then this kind of drives us right into the preferred partner program. And what do we do within the network to support our preferred vendors? We provide our suppliers and services to expand their visibility across the sales to the AIM and ACS community. And why is this really important? So as I mentioned previously, in the US alone, we have 2,100 plus members. Those 2,100 plus members represent nearly 10% of the industry's distributors. So what we're able to do is provide our preferred partners, whether they're suppliers or vendors, visibility and access across the marketplace. So what do? We drive them to the top of our search engines. We place them in preferred positions in our technology. We drive our purchase orders straight into their systems so that we have that efficiency, so that those orders come through very quickly, moving from keystrokes to click. We provide them with additional technology integration opportunities, guaranteed participation in publications, catalogs, merchandise campaigns, and we also give them visibility at our networking events via our social media campaigns. Everything that we do, what we do is to drive visibility and access to the AIM and ACS communities on their behalf. And how do we make money in this section of the services revenue? We do this through gross transaction fees on all orders through our supplier partner network and other vendors and service providers in return for providing marketing services, promotion of those suppliers to our distributors, technology integrations, all the things we just spoke about. And revenues from this source reflect the value of resulting purchase orders placed with preferred suppliers by our distributors. And you can see in the year we had an increase of 17% across our services revenues at £6.3 million. So now if we move to our merchanting programs, and how do we make money across the merchanting programs? How do we drive usership? How do we increase the growth of the AIM and ACS network? And we do this. Our merchanting programs are focused on operational gearing that drives efficiency and feeds into our services and our preferred partner programs as well. So all of these things work in tandem in order to grow the business. And so with our affiliate program, and this is that ACS affiliate services program, that capstone, we've been talking about this program and the launch of this for a little bit of time. We launched this late 2019. It was a very soft launch, very quiet, soft launch, and really went into effect in 2020. Unfortunately, COVID was breathing down our necks at that time, but we've seen the acceleration of our affiliate program. And so what do we do with ACS? We work to recruit high caliber sales professionals into our affiliate program. In this program, we are the principal in the sale. The technology use is mandatory. And this is one of the things that it really does drive that efficiency and really drives forth our efforts in the promotion of our preferred partners as well. And this provides the group with scalable expansion and growth back to the group itself. We provide administrative support that allows sales professionals to focus on what they do best, and that's to drive their sales growth. And so how do we make money in this scenario? How does this work on behalf of the group? We derive revenue from the sale of the promotional products, which is procured via our affiliates who act as sales agents. And in the year, we can see an increase of 142% across the market, the merchanting programs at 5.6 million pounds in revenue. And we are also working to continue to develop, and this is something that we've talked about in the past, and we're starting to see traction here, our move into adjacent markets. We are where we're able to work within non-competitive spaces, integrating our e-commerce technology as well as or order management systems. We pair that up with our supply chain know-how, and this gives us the opportunity to really enter into adjacent market programs. And additionally, one of the important things to note is that the group was able to secure a financing facility, which we've spoken about this previously in trading updates, of 0.5 million pounds to support the future growth of both our merchanting programs across adjacent markets as well as our affiliate program. And so how do we make money in adjacent market programs? This is through the integration of our technology and the sale of branded apparel and promotional products in alliance with our adjacent market partners. So we're able to take everything that we do and that we know and can do well and really drive growth via technology and via our supply chain know-how, and pair all of that up and be able to really target some adjacent markets, which we'll talk about in a little bit. We'll go into that further. And so over the course of the last couple of years, what have we been up to? Oops, yeah, pop back real quick there, Graham. Thank you. And this is a really important slide. And Graham, I welcome you to join in and participate in this. But since this 2018 year, and you can see in the columns, we cover off 2018, a 12-month period. 2020, it's important to note that was a 15-month period, so you can see that. And then 2021, where we were really in the depths of COVID across those 2 years, and then the year ended March 2022. So you can see that consistent growth. If we were able to slice that 15-month year into 12-month periods, you would see that continuous rise, that arc upward. So what have we done during this time period? We've dug out the foundation of the business. We've obtained the bank facility to assist us in growing as we go into the future. We've strengthened our technology through integrations, and we are ready to scale. So that springboard, we are at that launching point. We're seeing it happen across the business and the growth that we've seen in the year ended of March 2022. And we are continuing to drive forward into the future. And Graham, I know that there's always points on the slide that you like to hearken and tap into and share.
Absolutely, thank you. Yeah, the just to talk about the bank facility. So this is something we've got in place for future growth. We haven't drawn into it. It's there for us. We have a cash cycle throughout the year, which is not straight flat line. So therefore, that comes in handy when we've got growth on the cards, or when we are growing. I really like the adjusted operating profit loss line. There goes as an accountant speaking, where you've got where you can see that trajectory from 2018, 2020, 21, and 22, and that's really the acquisition of AIM coming to fruition. We've of the 11.9 million, 11 million of it is related to AIM or post-AIM business. So therefore, the ACS and adjacent markets piece is being organically funded from the success of services to actually launch those businesses, get the right structure, get the right people in place, so that then we can move forward, and those are our next waves of growth coming forward. So that's what I really take from this graph. I quite like it.
Awesome. Thank you, Graham. And so, Graham, you can continue to go through the financials, and as we can, we hit the financial highlights, but there may be some important aspects to this that we can run through as well.
Yeah, I'll skip because we've gone through the highlights, which covers off the key areas, but just to dwell on a couple of bits. So overall, it's very positive results. We've achieved a net profit for the first time, I believe, and which is great. Always nice to have. That we have been helped a little bit with the share-based payments, as there's been some credits coming through in the year. So even though we're on a positive trend, that might not be reflected in the near term, in the very near term as such. However, it's really good, and we've had the gross profit growth driven from services. So we've got that 0.6 increase to 6.2. Costs are very like year on year. And we have, that's all reflected within the EPS turn from a loss to a profit, and the adjusted EPS trend, as you can see there. Okay, and I shall move forward.
Mm-hmm.
So segmental performance. That's I think this is probably a good slide to just dig in a little bit into the margins. The increase in services, you can see we've got a 91% consistent margin fall through there. So therefore, that business, that activity within our membership, and flowing through to our preferred partners, that really drives immediate scalable growth of when that comes through. So that just falls straight through. Our merchanting, then the mix has changed from 30% gross profit margin to a 7%. So previously in 21, we would have had PPE coming through there, and also and ACS would have been our gross profit in effect would have been our sales figure coming through in the turnover, and in the year to 22, we are the principal in those transactions, and therefore we have the full sale of those goods and the costs of sales of those goods, plus the commission payable to our selling agents, our affiliates. So hence that's why the gross profit margin falls to a 7%. And the trajectory of that, with our expansion into adjacent markets, that will come through as a far higher gross profit margin in the way of within that segment. So therefore, that usually about 30%, for example. So therefore, as that grows, then we expect our gross profit margin to tend up. However, we're also targeting some real growth in merchanting in ACS. So therefore, the propensity of that to net off each other over the next couple of years, you'll see that play off against each other.
Yeah, and I think that Graham, we see a couple of questions too on the Q&A about that that gross profit margin, and so we don't anticipate, we anticipate that to rise, and so it's just really a matter of the timing of when some of the adjacent markets and the merchanting programs started that you're seeing fall through here. But I do anticipate seeing that gross margin rise, just as Graham alluded to as well.
Okay, and then moving towards our balance sheet or financial position. So we've got a positive net asset move year on year, and that's not driven by kind of increasing our deferred tax or anything else. That's driven really by our increase in working cap, and that's fundamentally driven by the trading and services increase, and our the mix between our trade and other receivables and cash falling around the year end is it interplays between cash and trade and receivables basically with our levels of our receipts around the year end. Apart from that, then it's pretty similar year on year, but it's a move in the right direction. Then in our cash performance, so we've got a strong starting point from our trading. Then what you can see in the movement in trade and other receivables is the 1.4 outflow, which is fundamentally driven from the increase in our expectations for our throughput revenue coming in from our services position. So that's what's driving that outflow, which is actually a very positive trading impact, and shows that growth and recovery coming through. We've had a double R&D tax credit within the year, so we've managed to speed up our tax returns and obtained 2 tax cash injections from that point of view, which is always helpful, especially in the environment we've had. And then that's we've continued in investing, and that's actually an important point. We've managed to continue in investing in our tech, and that's been a really important point. We've been able to really develop our roadmap and push through and targeting our customers' needs.
And to that point, Graham, because you and I have spoken about this, I'm sorry to have interrupted, but we have talked about this quite a bit, and I think it's an important point to make. That so the average AIM member typically is in that 300 to 800,000. We've seen a shift up now with our AIM membership. So their average turnover today versus the last time I spoke with all of the folks here on Investor Meet has actually increased to 1.3 million. That speaks volumes to the quality of services and the quality of tech systems that we have today. But what's really also very interesting is we're seeing a move from those large distributors coming to us for that ACS affiliate services program, as well as within the AIM network. And who's talking to us now, Graham? You and I talked about this previously. It's the 1 million, 3 million, 5 million, sometimes higher. So we're starting to see some really wonderful traction because of that open environment and the efficiency that we're able to drive through our tech platform and the marketplace that we've built out.
Absolutely, and that's where I think probably originally when ACS was launched, then it would have been more the 350, 500k kind of, the tech would have been really suited that, being our sweet spot. And actually what we're really seeing now is the markets opened up in our last quarter of the financial year, that we've seen that movement, and those higher values and the referrals that we're getting through through our ACS network is actually really proving out. So that's been very positive and encouraging. A lot of come from a lot of hard work from Nikki and the team over the last couple of years. I can't take the credit for that. So anything else on this slide? Sorry, I think that then shows that's basically then falls through to our cash outflow. soon to be. Then soon after that, then we get a lot of those receivables coming through on our trade and other receivables.
So on the blue sky and market opportunities, and how do we continue through the operational gearing and everything that we've seen? How do we continue to grow the network? How do we continue to grow the business and drive that exponential growth? And currently, we've exceeded the pre-COVID network numbers with more than 2,122 distributors within the North American network. Again, representing nearly 10% of the industry's distributor companies. But what does 10% mean? That means we have 90% to go after as well. So I see that as a very big opportunity for us to continue to grow the AIM network. We saw very little attrition of the AIM network through COVID. However, what we did see is we saw the attrition of the lower value distributors that were ready to either go into a different profession. Maybe they were a hobbyist, and or they retired. And so now what we've done is we've bolstered up our network with better quality distributors. That 2,122, as I previously mentioned, now we're seeing them with a higher turnover average of 1.3 million. So I think in years past, when we started and had recently acquired the AIM network, we were looking at about a 800K average turnover. Today, it's 1.3 million. Again, the market's highly fragmented, so that network of 23,000 distributors, there is a lot for us to be able to go after in terms of recruitment into AIM as well as into ACS. And just understanding that the top 5 market leaders, distributor organizations, represent a small segment of the marketplace at somewhere around circa 3 billion sales. Post-COVID, the Advertising Specialty Institute marked the ongoing resilience of the North American promotional products industry, with the total annual revenue rising to $2.2 billion in 2021. And again, that's up from the COVID impacted 2020, and we do expect to see that continue to rise. Historically, the market has surpassed its mark of pre-incident, right? Whether that was 9/11, the recessionary periods of 08 or 09, and now through COVID. So we would anticipate to see that rise. It's wonderful to note that the promotional product industry seems to be fairly recessionary proof. Those products are important to companies, and those companies, that pass along rate and the impact that promotional products have is an important one in terms of advertising and marketing spend for corporations. Our e-commerce, we know that this continues to drive sales activity across the industry. Promotional Products Association International reported on June 1st that the share of online sales of promotional products has increased. So up from 17.3% in 2020, it's now sitting at 25.8%. We have robust solutions to provide our network for e-commerce, and we're working on these things to drive them and expand them and grow them every single day. So our e-commerce platforms are strong, and you see that with the more than 2,600 sites that we have live today in terms of websites, pop-up stores, company stores that we provide to the network membership. Coupling this with the size of the untapped addressable promotional promotional product market with our robust softwares, we see that the market opportunity for the group is strong. And we also know that there are adjacent markets that we can tap into, that we have access to, that they are non-competitive spaces. And the print side of the adjacent market, 78.9 billion marketplace, uniform markets, 12 billion, printed signage, 10.6 billion, and the collegiate markets are 10 billion. So this provides us the expansive potential to increase our addressable market substantially. And so that we know that these are areas and industries where promotional products are sold, and we know that we can integrate through our technology services and to provide our supply chain know-how as well as our access into markets to be able to provide services back to these adjacent markets to help drive growth.
That's right. It really hits our sweet spot of our tech interplaying with our network and our relationships that we have. It's a strong point for us, moving forward, and I guess via ACS has really proven that out.
Yeah, and so it's really, one of these things when we talk about operational gearing, as the marketplace grows, we grow. So as we add in these various different opportunities, and we're starting to see adjacent market growth today. And so as we continue to tap into these markets, as our marketplace grows, we grow. And that's a really important aspect to remember. So all of these things will feed back into our preferred partner programs. They feed back via our technology systems and understanding data trends and being able to offer, the right opportunities and products and services at the right time. And so our outlook. So our preferred partner service fees tracked 32% over last year, demonstrating recovery and gaining momentum into the new financial year. We spoke about this at the start of the webinar. But a 32% increase across our preferred partner service fees. That's a really important stat to remember. Our merchanting programs are expanding and driving new growth within the promotional products industry and those non-competitive adjacent markets. We're working really hard on these various different aspects, and we're seeing that start to really grow across the business, and that shows up in the year's numbers. The group remains debt-free, and we have a credit facility now in place to support the continued growth and expansion of the business. I can tell you, for me personally, it was really, really important for us to get through that COVID period to be able to obtain that credit facility if we needed it to continue to grow the business, and we were able to achieve that. So we were able to achieve great things through that COVID period and continue to drive forward innovation and the various different programs of the business so that we could really have that springboard to jump off of. And the board is, oh yeah, go ahead, Graham. Yeah.
Right. Just to add to that, that's Nikki's grown the teams really effectively since from a team of one, I think, in the US, that is, and so over the last three or so years, 3 or 4 years. So then those growth in those in the merchanting and the teams below each of the different areas are there and operational, and that's where when those growth comes, that when growth coming in doesn't therefore isn't necessarily therefore we'll need to get another team to manage it. It's they're all in place and they're all working with pipelines. So I think that's a real nod to Nikki having those really good people in place, leading those areas.
And that actually helps to answer. And Graham, we can really touch upon this. Is one of the questions that I see here is operational gearing. Can you talk through the operational gearing of the business? If turnover was to double, how much additional cost would be needed? And what is the incremental drop through? So we've really built out teams. Our teams are ready to scale the business. And I think that's something that's really important to note, that in our in the way that we have developed the business, that we are really in a state of growth and expansion for the business, but not on the operational side of the business, not having to add in a lot of extra cost. And can you speak to that as well?
Yeah, I mean, I think it's because we've got different parts of the business, then it has different answers to every different part. So it's not a simple, just here's the answer. But the so if our services grew, then we wouldn't have to increase really any or much of the team fundamentally. I think that would be more of a choice if we want to try and go into our membership base a lot more a lot deeper. But we don't. That's not something necessarily we need to do. So therefore, that's the services incredibly scalable. Our ACS and merchanting side is there would be some elements of some step costs over time, but it's not a variable uptick with with the increase in that revenue. So you can really see a lot of increase in revenue with very, very low levels of increase in the in our overhead.
In team costs, yeah. And I think that really what it speaks to is we would not need to, as we expand, it's not a massive investment in staffing. It's really an incremental increase as the business grows. And so back to the remaining debt-free, have a credit facility in place to support the growth and expansion of the business. And that also kind of speaks to that as well. And so where do we sit today? We are confident in the future scalability and success of the business and the executive management team's ability to successfully execute on the group's strategy. We are very, very focused. We are, as we mentioned at the start of the program, we are very much in the position where we roll up our sleeves and we do what needs to get the job done. And so we're very much eye on the prize, focused on what we need to do to achieve this year and beyond. And I can read through this really quickly. You've probably seen it in our results, but I can read through it because it's very much where my heart is and where my focus is on the business. So the group experienced a year of strong, profitable growth driven by the commitment of our teams and the quality of our programs. I will tell you all, our team is second to none. We truly have a great Class A team. We're also extremely pleased to see last year's strong trading momentum has continued into the first quarter of our new financial year, providing further confidence that the current market expectations are at least in line for the full year. We have continued to be nimble and drive the business forward through the most uncertain times, building a strong foundation and delivering year-over-year positive growth, whilst remaining debt-free and not raising dilutive funds. We retain our high growth ambitions and are confident in our ability to substantially scale and expand the business. This is where we are today, in the position to be able to substantially scale and expand the business. And so I do see that we have a couple of questions, but I want that to just sort of sink in with everyone. We're really feeling great about where we are today. I will remind everyone that our first quarter of our financial year has just ended. So we really are just getting into our second quarter of the financial year. So as we answer some of these questions, it might be a bit soon for us to jump in and dive into all of the questions that you have, but we really will work hard to go through and answer. There's lots of questions here. And we'll also make sure that we answer any questions that we can at the end of the, post today's event. So one of the questions I saw here, Graham, and you could probably speak to this. I can speak to it, but you'll speak to it a bit more knowledgeably. Is about the strong dollar against the pound right now, and can you speak to that a bit? And I can share that yes, most of our revenues are in U.S. dollars, so a strong dollar certainly does help us. But can you share your thoughts on this question as well?
Yeah, sure. So we've got a UK cost base as well, and therefore with the more amount, the higher revenues coming from the US and some costs coming from the US, therefore there is a profit in the US, and then when that's converted through, then that's rates compared. The rate is now favourable for us in this year. So as long as that happens, then that will be positive for us. With our UK development costs and some overhead costs there, which serves the group, therefore that actually means that that's a cheaper cost for us as a with predominantly US numbers coming through.
Awesome. And then I also see in here questions about ACS and does it generate service fees and some of the scalability of that program. Yes, that program is highly scalable. It does generate service fees. And I would also say that as with all of our programs, they all feed into each other. So what we aim to achieve, and we've got about 65% of our 65 or higher of our ACS purchase orders and everything goes through our preferred vendors. So all of these elements will help to drive growth across services as well as across the merchanting. So we do see all of those things sort of, cogs that help to drive each other for growth of the group. And so it is one of those things. We also have that question too about the gross margin, which I think we've hit upon. We do anticipate as the operational gearing of that program and the addition of the adjacent markets programs that we are working on and that are growing today, all of these things will work to drive the gross margin on our merchanting revenue lines.
I think on the first question, I think pre-submitted one, then I think we've covered off the underlying factors for the growth that we see coming forward, where I think it's mentioned something like 18% this year and 40% next year. So that's that's fundamentally from our merchanting arm, but plus some further growth within services coming from a mix of recovery and growth that that outside of just the US economy recovering. And the US economy is important because that's where we operate in a lot. So yeah, and that's actually coming across right now as relatively buoyant, and even in some uncertain times that we're still in, unfortunately, but that's coming through as positive right now.
And I think that we're just about out of time. So what I will say, I think it's very important to note the mindset in the U.S. And then any questions that we may have missed, we will absolutely get back to everyone again post this event. But we've just had a very, very positive jobs report out of the U.S. So jobs have now gotten up and over where we were pre-COVID. So we're achieving pre-COVID jobs numbers. And I think that in the U.S., we are seeing very robust trading and a lot of enthusiasm. So the while there is recessionary concerns, there's sort of a 50-50 split across the U.S. about what will happen in terms of a recession, whether there will be one at all or whether we're in one right now. But it will be a small blip in time, and that the U.S. markets are really nose down and all about continuing to scale and grow. So I think that it does remain to be seen in terms of the recessionary woes in the U.S., but I think that the U.S. overall is extremely upbeat. And if there is to be a recession, the mindset is that it will be very brief, one quarter, maybe 2 quarters tops. But I think that everybody's very, very bullish in the U.S. about growth, and especially on the heels of that very positive jobs report that we just received a few days ago. So with that, I will hand back over to Alessandro. Thank you so much for everybody joining us today. If we didn't hit your questions, we certainly will as soon as we possibly can. And thank you for your time and joining us this afternoon.
Thank you very much.
Nikki, Graham, thank you very much for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Altitude Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.